I see you shaking your head. Weigh in here.
Well, actually, I think Rick is exactly right in the context of thinking about where are we in this normalization process. So the Fed has moved well over 400 basis points. A year ago, our expectation as a market was that they would move 100. So this has been enormous, a huge, huge change. And we're probably more at the end than the beginning of their moves. Now, why is the market down so much today? Of course.
I was going to say, if we're more at the end than at the beginning, why are we down another 3.5% on the NASDAQ? You know, why are we concerned now about the chips? Why are we thinking now the auto sector has excess inventory? It feels like they're all telling us these shoes are still yet to drop.
I think we're seeing a confluence of where is the economic data, which is still pretty good, right? We saw consumer confidence 24 hours ago, a little more. That was great. Consumer confidence still looking good. Banks still healthy. There seems to be a pretty good consumer balance sheet out there. Meanwhile, some companies' forecasts for earnings are more troubled, Micron being a great example of a more cyclical name. So I think it's that confluence where we say, hey, look, the Fed's not going to necessarily cut soon, although I think sooner than they think that they will. But the Fed's not going to cut so soon, so we're going to have this weight, this higher cost of money, which is going to be more challenging, especially for more tech-heavy names.
So, Dom, we have Micron. Okay, so do we blame them for the NASDAQ being down? Why is Micron down 5%, but Lamb's down 11%, right? What is that all telling us about this highly cyclical, usually leading part of the market? It doesn't feel like it's a good sign.
Or Applied Materials, right? So Lam and Applied Materials are kind of in the same business. They make the equipment that makes computer chips. If you have a supply problem, if you have an inventory problem, a possible glut happening, that probably means that you're not going to have to make as much going forward before you clear out the inventory. Now, that's an overhang for memory chip makers. Then that sentiment is carrying through. More to the discussion about the rates and the global economy slowing down. I mean, there's been so much negativity about what it could be like for a recession, whether it's going to be shallower, soft landing, or whatever it is. I guess maybe one of the things that a lot of investors are trying to grapple with right now is whether or not the earnings picture. We've spoken a lot about multiples over the course of the last several months, about how higher interest rates means that there's an alternative. Opportunity costs are now more profound, and then that could mean valuations come down.
Right.
Well, right now, the earnings story isn't all that dire, at least not for right now. So
even a lower multiple could be a decent price.
So what you have is a multiple contraction, even on earnings, that may not be as bad as people fear. And this could be an earnings season, by the way, coming up, where CEOs are just going to take the opportunity to guide lower because they can. Because they can.
Well, and look at yesterday, Rick. We were talking about Nike and FedEx and how great, hey, maybe earnings season won't be that bad. And then today it's taking down the whole market. And, Rick, I also wanted to ask you this, because it strikes me we're talking about one leading indicator, let's call it the yield curve, looking better today, while other leading indicators, like the chip sector, for instance, are looking a lot worse. Why are they at odds?
Well, I think they're at odds because when you look at the yield curve, it isn't necessarily, don't think about it in recessionary terms. Think about what the behavior is behind the scenes by investors. Okay, they're finally starting to challenge the 2-year, which they think the Fed's closer to the end. They're being more aggressive in selling longer-dated treasuries, and those are normally considered to be spongy when you think we're going into recession. I just think that the U.S. will fare better if the Fed has more confidence in the self-adjusting mechanisms of the Treasury complex. Their guidance isn't going far. And as to your question directly, I think the equity markets have big problems. So when I look at Nike yesterday or when I look at Micron, I don't look at it the same way as other investors. When it's going up, to me, it's a bounce and a bear market, and they need to be challenged. We've been having central banks manipulate markets. We still have the Bank of Japan ownership in markets beyond the pale. It's going to be painful trying to normalize. We've barely scratched the surface.
Do you agree with that, Jason?
Well, I actually think that on one hand, it's not necessarily at odds in the context of when you actually see the curve re-steepen, that's actually the beginnings of sort of when the recession really occurs. So what it means is the market's believing the Fed is going to start to say, oh my gosh, this is getting bad. With regard to the Fed having a lot of problems, that reminds me of George Costanza in the Festivus, where he's got a lot of problems with these people. I think the Fed does have a lot of problems with the equity market. And one thing we do have to understand is that they actually have said almost outright that they'd like to see it go down. that's a significant headwind. I just think that headwind over the next 6 months is going to go away, and the real headwind is going to be actually what the evolution of the economy.